Thank you, Carl and Sarah. Welcome to Halftime Report. I am Frank Holland in for Scott Wapner. Front and center at this hour, the November setup for stocks. How should you position your portfolio as we head into the final stretch of the year? Our investment committee is standing by with their playbooks. And joining me for the hour, we got Joe Terranova, Kate Moore, Carrie Firestone, and Steve Weiss. Before we get this debate started, quick check on the markets. You can see the S&P and NASDAQ both in the green, both about 1% away from a new all-time high. The Dow pulling back about 180 points. The Russell down there pulling back about 0.75%. With that, Joe, I turn to you. New month, very strong year. November, historically the strongest month. But is it now time to maybe shift your strategy after we saw AI and the tech trade move the markets higher last week?
Well, it depends what your strategy is. But overall, when you're looking at the market, it is now a much more difficult environment than it was 30 days ago. 30 days ago, you had the benefit about speaking about the broadening opportunity, speaking about the variety of different sectors that were working. It appears as though in the last week, for whatever reason you want to cite, the strength of earnings, the relationships, new agreements with OpenAI, find what you wish, but it is very clear that we are back to that concentrated market once again today. S&P equal weight's down 50 basis points again today. That's a difficult environment for portfolio managers, because as a portfolio manager, you are managing risk, most importantly. And when you're managing risk, it's difficult to say, I'm going to own 7 stocks in a portfolio, and basically that's it. So it's a different setup coming into this month than it was 1 month ago, because you're not getting rewarded like you were 30 days ago for the broadening out.
Yeah, I think you're speaking to some of your own struggles. As someone who runs an equal weight strategy, you're seeing this kind of concentration in the market.
It is clearly frustrating. We'll talk about that a little bit more. Fortunately, we're okay today, but we're certainly not going to compete with the S&P 500.
All right. Kate, Joe's mentioned in the last week or so, if you look at the last month or so, if you look at the equal weight, underperforming by quite a bit, down more than 2%. You're looking at momentum, that's underperforming in the red, and even dividends. A lot of people said it's time for a flight to quality. Even dividends, if you look at the SDY ETF, that's underperforming. Are you concerned about this concentration when it comes to tech and the fact that all these other plays, well, at least the first two that we saw have relatively strong years so far, seem to be underperforming over the last few weeks?
Well, look, I'd be a lot more worried about this market as we get into the last 2 trading months of the year if what was driving the market was not fundamentals, right? And the truth of the matter is these large mega cap companies, it's beyond just the Magnificent Seven, into all of the tech and tech adjacent leaders are putting up great fundamentals. They're producing free cash, and they're continuing to manage through a challenging investment environment. Like, if we were just about multiple expansion in 2025, I would be a little bit more uncomfortable. But I hear the point here around the equal weight versus the market cap weighted S&P. In fact, we did a study of this just over the last couple days where we showed that really since 2023, there have been only 2 months where the equal weighted S&P has outperformed. And when we look at this on a Z-score basis, we have a 3 standard deviation outperformance of market cap weighted stocks relative to equal weighted. So as uncomfortable as that is for portfolio managers, and I completely hear that, I think we have to stay really focused on the large cap free cash generators, which unfortunately are the bulk of the market cap.
All right, Carrie, you feeling uncomfortable at all? You feel uncomfortable with your tech winners powering your portfolio, powering the market?
Well, I would say that the concern is that the free cash flow of these mega caps is not as great as it was. They're borrowing money. They're all issuing debt. They're using hundreds of billions of dollars in order to pay for their AI build out in whatever way it is, buying chips or paying for a data center. And therefore, we're relying on these companies to push the market higher and propel it when the free cash flow and the earnings growth that has supported it is not as strong as it was. And how can it be when these are the biggest companies in the world? They're the biggest companies that have ever existed. They justify the size that they are, but it's a concern. And the rest of the market that was trying to participate has failed to participate. I mean, that broadening, which people were so excited about a few months ago, just disappeared. And we were not big adherents of it, but what we believe in is that it's important to diversify your portfolio, not own 8 names, each of which is 10% of your portfolio, and then 2 other names or 3 other names in there. I mean, that's not being a portfolio manager, but it just hasn't worked. Therefore, these companies, whether it's Meta, Google, Amazon, Microsoft, Apple, they have got to continue. There's more pressure on them, and it would be better if we saw a little more spread of that, and that's why the market could correct And we wouldn't be surprised.
Wait, sorry, Steve. Are you saying that's a warning signal? Because it's odd enough that you say that today. Bank of America out with a note saying that right now companies are spending about 94% of their operating cash flow to do these build outs when it comes to CapEx, if you subtract dividends and buybacks. So is that a concerning sign that they're spending so much of that cash flow in this one area?
Sure. Of course it is. Now, it doesn't mean it's going to happen, but yes.
Is the borrowing concerning? We're talking about Meta, I'm assuming,
Yeah.
Borrowing money. If the demand is there, is it concerning that they're borrowing the money?
Of course it's concerning, because when you're generating $100 billion and then suddenly you're borrowing $5 billion or $10 billion, yes, of course it doesn't mean it's going to happen this quarter, but we have to make sure that they begin to generate revenue and profitability from what they're spending on.
Steve, I want to come over to you. By the way, Jim Lebenthal on here saying it was just financial engineering. I believe that's what he called it last week, that it wasn't such a big deal. Basically, that's what you learn in business school, that the borrowing wasn't concerning to him necessarily.
Financial engineering is never a good term. Never.
I disagree with a lot of what you said. First of all, running a concentrated portfolio, I'll take the words of some of the greatest investors of all time, like a Buffett, diversification is the enemy of performance. And we've seen that time and time again, and perhaps that's why 75% of portfolio managers underperform the S&P every single year, and it's not the same 75%. So I prefer a concentrated portfolio, and am I worried about a concentrated portfolio? I'm always worried about it. Anytime I have anything at risk, of course, there's concern. Right. But that question's been asked so many times over the last 5 years that, eventually it's going to be right for a nanosecond. Maybe we saw that nanosecond, but longer term, you go with permanent compounders, you go with Fort Knox balance sheets. And by the way, putting debt on a balance sheet when it's not an issue what your coverage ratios are is a good thing because it's leveraging your returns. So I'm a fan of debt on a balance sheet for companies that can afford to pay it, and I don't look at it as a weakness. Now, in terms of the mega cap, what we saw were some mixed earnings, Meta being, I'd say, in terms of stock reaction, dog of the group, but they're doing exactly what I want them to do. They're investing in the future. So I took the opportunity to put on Friday a small trading position. It's already a big core position for me, but I'm looking to take advantage of it, as I did with Google back then. So, coming into this month, as Joe points out, it's a different game, but it's a different game because the Fed, is saying, I'm not guaranteeing you that we're going to cut rates. And that changes it, and that also limits the broadening of the market, in my view.
By the way, Kate,
that's well said. And my opening remarks are not to suggest I think the market's going down. I actually think you're going to get the continued. You will get the continued chase for performance, but I think Steve is eloquently defining the environment. It's just a little bit harder in November than it was in October because you can't come on the show and say, "Oh, the financials, they're going to be a great place to be."
Don't fight the Fed,
right? And you got the earnings, they delivered in the financials, but you did not get the price reaction thereafter.
That's right.
That's a challenged environment.
Okay. So not a foregone conclusion to you. That's a significant departure from everything else, data dependent. And Kate, I saw you nod. I mean, just not a foregone conclusion. That's just a total sea change in your mind when it comes to the Fed?
Well, let's be clear. I didn't think October was a foregone conclusion despite the market pricing. And no one was asking me to vote as part of the Fed. But I was looking at the data, and the inflation data, both the official stats as well as what we were hearing from companies, was suggesting that inflation was percolating, that lots of kind of third-party and alternative data sources that we look at in terms of prices of imported goods were actually going up over the course of October. It wasn't necessarily an environment where if the Fed has a dual mandate and they care about both sides of it, that it was clear to them that they should be cutting. And I think that's what played out last week. And we're going to have this litigated in the media over the next 5 business days. We have 12 different Fed speakers coming out to talk to us, telling us their specific views. But I think a more consistent debate, as opposed to an expectation of Fed cut after cut after cut, is going to be more of the rule for the end of the year.
Don't we get to a point, though, even if the Fed doesn't cut in December, where the market dismisses it and says, okay,
yeah, that's a one-off.
In May, we've got a different Fed chair, we've got a different disposition on the Fed. They almost is not going to listen to the message of the Fed. At what point?
Well, I think we're going to have to see. There are people who have aligned themselves with this administration on the Fed right now who also said it wasn't as much of a slam dunk to cut by a large amount in October. I want to believe in the independence of the Fed and the consistency of the way that they evaluate the data, both on the inflation and the labor market side, to make their decisions, regardless of who is put in the chair. So I'm going to continue to believe in the institution for the time being.
Yeah, I think that it gets really, really tough once Powell's out. Particularly, you have a Kevin Hassard, who is such a sycophant and just believes that rates should be zero, taking the word of somebody who's a real estate investor. Real estate investors love leverage, and of course, they live off low rates. The lower, the better. But we'll wait until we see what happens then. But I think it'd be very troubling. Now, what's going to happen in the interim? We've got the government shutdown. There's no sign of it ending anytime soon. So we'll be explaining away the disruption in the economy by so many people, not getting paid because the government shut down the largest employer in the world, right? So that's one thing. Inflation's going to continue to be an issue. What we really haven't discussed is how we've shrunk the labor pool so much with the immigration policies. And I'm not saying I'm for it or against it. I'm just saying it's a fact. We've shrunk it. So particularly in skilled labor, which they generally weren't skilled labor, I'm talking about electricians, et cetera. We've already seen a tightening there. We've already seen.
And you're saying that's inflationary.
Right. I'm sorry?
And you're saying that's inflationary as well?
Yes, of course it's inflationary. So we'll see wage inflation go up. And we'll see, more of automation. Automation will be the balance. But talking about AI, and while we've seen a number of AI cuts, you really haven't seen that hit in force. But that's going to change some things as well. So it's just not clear sailing, right? But there are always concerns in the market. What hits you generally is what you don't foresee. Right? That's the real, black swan.
If I could just give three quick names, you want to watch the home builders, because in the last month, everyone said, okay, rate cuts are coming. You want to buy the home builders. Well, D.R. Horton, Lennar, if you could show a 1 month chart as I'm speaking, please, on Lennar, you'll see what Lennar and D.R. Horton and Pulte and NVR are doing. They're not responding. They're not responding in the way that we intended, on the belief that the rate cuts were coming and it was going to be this healing medicine for the housing market.
And to your point, we got manufacturing data today. We got ISM and also PMI. ISM's in contraction. At the same time, PMI, some notes from it. Tariffs remain a key source of higher input costs. Selling prices were raised markedly in response, sharply higher prices out of the PMI report. So I guess that kind of leads to the idea it's not a foregone conclusion. Maybe inflation, it moves a leg up. TD Cowen out with a note earlier today saying, or over the weekend, I believe, saying that basically retailers, they've kind of lost their ability to absorb margin, and they've also worked out a lot of their inventory on lower costs. So now we could potentially see higher costs, maybe even as soon as the holiday season. So I understand what you guys are saying, but it just, the words from the Fed itself didn't seem to change a lot. All right, I want to go back to the concentration conversation. Joe, I want to come over to you. We talked about your rebalancing of the GOT ETF, the Halloween rebalancing, and the question was going to be a trick or a treat. So you tell us, which one was it?
Well, I certainly think that I always say what I want the index to reflect is what's the personality of the market. And something that was very clear to me is in July of 2023, we began to build significant exposure in the financial sector. We increased our weighting at that point to overweight. This is now the first rebalance since July of 23, where we've seen a significant reduction in financials for that sector, 35% down to 22.5. We'll get in more depth at what actually came out, but really, where did we see the increase in weighting? And it was technology. And it was very obvious to us that it was going to be technology. It was going to be the momentum-driven names like Apple, like Qualcomm, like Applied Materials, like AMD. All of these technology names have remarkably strong momentum behind them, earnings growth. The one name that didn't make the cut was IBM. I was surprised by that. I thought IBM would, but IBM has a high debt-to-equity ratio. That is one of the criteria for the quality factor, so it was disqualified for that. But it's a very clear increase in exposure to technology.
Really quick, the two that you got out of there, Checkpoint Software and Tyler, why those two?
Both of those lost significant momentum. Checkpoint is, I'll tell you, is disappointing to me. Israeli-based company. I made it my final trade several times. In particular, an environment we're seeing CrowdStrike at an all-time high. We're seeing Palo Alto Networks working as well. So there's been an idiosyncratic challenge for this company more than anything else. That's been frustrating. And the momentum criteria didn't qualify.
Yeah, while we're talking about tech, let's talk about one of the biggest tech names last week. Of course, that's Amazon, hitting a new record high today after announcing a new partnership with OpenAI. Our Mackenzie Sagalos joins us now with the details on this new partnership. Mackenzie.
Hey, Frank. So Amazon now on pace for its biggest back-to-back gains in 3 years after announcing that it signed a $38 billion deal with Amazon Web Services and will immediately begin accessing NVIDIA GPUs through the Amazon cloud. Now, it marks a significant move away from Microsoft, which was OpenAI's exclusive cloud provider until earlier this year and had right of first refusal up till last week. The partnership gives OpenAI more flexibility as the company rushes to scale up infrastructure. Now, as part of the contract, Amazon will also build out new data centers specifically for OpenAI. And this is just the first of several unnamed October deals that CEO Andy Jassy teased on the earnings call last week, part of why they're pacing toward a $200 billion plus Q4, the first company to hit that landmark, Frank.
Mackenzie Sagalos live with the latest on Amazon. The latest on Amazon. Amazon shares seeing a new high, up just about 5% right now. I want to toss this over to you guys. Kate, I want to come back to you. We were kind of talking about concentration when it comes to tech, but when you see those earnings from Amazon, the results, new deals being announced, also kind of broadening out its AI exposure before, where there's a lot of questions about, hey, is Amazon being left behind when it comes to the AI race? A new deal here. They also have a tie-up with Anthropic. Just your take on the idea of AI. It seems like more and more of these deals and more companies kind of broadening out their reach and their connections.
Yeah, so one of the big takeaways I had from the earnings last week is the four hyperscalers. Obviously, we're talking about CapEx. We were just talking about that a moment ago. And yes, it is true that there's a small amount of debt being used, a little bit of leverage, more so than in the past. But that wasn't worrying for me. I share Steve's view that sometimes that actually makes sense. And it's very small relative to overall cash flow at this point. But the other thing I took away from the hyperscaler earnings was actually that the amount of backlog of demand for a lot of these cloud services. And we're hearing from many companies that they're continuing to sign new contracts, that they are extremely excited about continuing to expand their own investment there. So it just wasn't the spend from the hyperscalers, it was also the demand for their services that got me excited. And again, I know it's uncomfortable to have a concentrated market, but these fundamentals are still strong.
All right, we've got a lot of Amazon ownership here on the desk. Carrie, I want to come over to you. Your view on this deal?
Well, Amazon is one of the companies that really benefits from AI. They make money because of AWS. And part of the reason the stock has underperformed was because AWS had a weakish quarter last quarter. It showed this quarter that they returned AWS to more than 20% growth. And it's like Google in that they're making money by cloud support, and all of these other hyperscalers need them, plus everybody else who is trying to support their AI effort. So yes, I mean, the business underlying the retail was strong, but AWS was particularly strong. And OpenAI, they need more power. So does everybody. So I'm not surprised. And it's the amount, 38 billion. We're not talking about 100 billion or 200, where you have to question whether it's for real. I think this is for real, and they'll get paid.
You know, it's another day. It's another OpenAI deal, and
that's kind of what I was asking Kate. It seems like every day we get a new
That's
deal.
what I was complaining about last week. I was complaining that Amazon didn't have the agreement with OpenAI, and to your point,
they were just further down the queue.
Just weren't patient enough.
Yeah, so, look, if Versant Media, CNBC, comes out and announces a deal with OpenAI, doesn't have to give any details, the company would be worth a lot more.
I feel like you're being a bit sarcastic. You're saying these deals are a bit nebulous.
It's not my brand, Frank.
But it was Apple, it was Alphabet, and now it's Amazon that were very slow in 2025 to establish new all-time highs. Here we go. Amazon's done it today. There's one left, Tesla. Tesla, I think, has its all-time high at 488 last December. Steve, you'll be happy to know we actually sold out of Tesla in the rebalance. We had bought it at 310 at the end of July. The problem was on the revenue growth score, the last 4 and 8 quarters are negative. So the revenue growth is not there. So rang the register on it. I'm sure it makes a new all-time high after we do that.
I just hope you don't get chastised as much as me for not being a devotee, regardless of poor governance, regardless of
We have no feelings.
That's enough said.
No feelings.
Steve, I want to come back to you very quickly. We're talking about Amazon, though. Is it a good sign for Amazon to see them basically broadening out their bets? I mean, they had Anthropic, and now they're with OpenAI. Obviously, the door seems to be open for deals with other these AI companies. Is that just a positive sign, even if you think it's a bit nebulous and you're feeling like there's not enough details?
Look, yeah, on balance, it's positive. We really don't know all the details of these deals. But look, if you're in cloud and you've got 3 major cloud players, you've got to be involved with OpenAI, period, end of story. So it's more like, as we've talked about in the past, it's vendor financing that we see. And the question will be, can OpenAI, live up to their commitments in terms of their need for the data centers and the capacity that they want to take on the cloud?
As long as we keep hearing about these deals, the semi-equipment names will work. All 3 of them, the major ones, will benefit. KLA Corp, Lam Research, Applied Materials, and there's one more, which is Teradyne. I think Stephanie Link bought that recently. Teradyne has had a really strong price appreciation over the last couple of weeks.
Yeah, to your point,
but also, Vertiv. Vertiv's going to continue work.
To your points, back to the chips. I mean, a lot of bullish notes about NVIDIA. Target raised from 250 to 350 by Loop. Also, some news that the U.S. is going to allow Microsoft to ship NVIDIA AI chips to the UAE for the first time. Not saying it's a huge market, but it's obviously an emerging market, one they weren't in before. And then it seems like these things with China are going to be resolved, Kate. I mean, overall, when we're looking at the idea of U.S. technology and the U.S. tech stack being around the world, the fact that these deals, sometimes small when we're talking about UAE, but bigger when we're talking about China, isn't that just another tailwind for this tech trade that makes it, quote unquote, more real, even though we have some people who are skeptical of some of these circular deals?
Look, I would approach the Chinese tech story a little bit differently, which is to say it's great if they can get some chips, but the bigger story, I think, from the last week and from the conversation between President Trump and President Xi was effectively that, hey, we're going to hold things steady for the near term. But the strategic competition between the U.S. and China is still very, very much in play. And in fact, we need to understand that in order to get access to the best technologies in the world, we need to separate out our investments in the U.S. technology stack and the Chinese technology stack. I prefer this kind of parallel, and we added to Chinese equities over the course of the summer, largely because we have this constructive view on government support for their semis business, for both their hardware, their software, their AI, and eventually their quantum.
When's software and cybersecurity really participate? You mentioned that you sold out at Checkpoint. Cybersecurity, CrowdStrike seems to be the outlier here, but the rest of the cybersecurity sector just continues to lag. Do you have a sense in your mind when you think is the time to kind of get on board cybersecurity? Because it seems to be the unloved part of tech.
No, I wouldn't say that. I think Palo Alto and CrowdStrike have worked remarkably well. I think the bigger question is how much market share are they actually capturing? And that's the reason why we're seeing this bifurcation in performance. So I think you're still getting rewarded for being in cybersecurity.
But those 2 names in particular, when you look at the broader sector, some of the ETFs, those are lagging. So you're just saying it's all about market share. These two,
they are,
the 2 dominant players taking the market share.
I think it's somewhat similar to right now the market share gains that you're seeing from Broadcom and from NVIDIA. Very similar parallel in terms of performance and growth.
It's software such as Adobe and Autodesk that's really getting hurt. I mean, you have to differentiate within the software segment broadly because Microsoft is a software company, but CRM and many other names are being, I'd say, brushed with the AI is going to kill your business stroke, and that's what's been hurting your stocks.
And a lot of that coming from the labor side as well, because if you're a seat-based software company, based on the number of your licenses, that's obviously going to be a significant challenge. So something else I'm watching across this earnings season is how companies are talking about their labor force and specifically how they're thinking about forward hiring. We've gotten very muted commentary from companies there because many of them are waiting to see whether or not all these AI use cases lead to productivity gains. And obviously, you're going to hold off on announcing any kind of workforce expansion or, in some cases, layoffs until they have that information.
And that's a great point we really haven't talked about, which is that you're cutting 14,000 white-collar jobs at Amazon, right? How many of those had a license to Salesforce, had a license to pick the software company, right, including Microsoft? So it's a real consideration, and that's going to be an ongoing story as AI use cases proliferate.
14,000 corporate jobs at UPS as well. So about nearly 30,000 of those corporate jobs you mentioned, a lot of them may have had some type of license to some type of software product. And we're seeing layoffs potentially in other parts of the market as well. Very quick note before we go to break. I want to make it amends with my friend, Farmer Jim. He did not say financial engineering. That's what I said earlier. He actually said textbook corporate financing. I know his ears were burning out there on the farm.
Oh, boy.
All right, coming up here on halftime. The deal of the day that's creating a consumer staples giant. We're going to debate more of today's biggest movers and our top calls of the day. Halftime's back in just 2 minutes. And welcome back to halftime. Let's get to some stocks that are on the move. Kimberly-Clark is buying Kenvue in a $48.7 billion deal. You can see shares of Kimberly-Clark pulling back double digits right now. Kate, I just want to start with you. Big deal in the consumer staples space. This sector is a big laggard. It's negative for the year.
Yep. Just
your view on this deal and the idea of staples, the defensive sector. Is that a place that you want to be right now, and the idea they could bounce off these lows?
I mean, I'd love to think that we could have some of the laggards lead to outperformers, but, just looking at third quarter earnings, staples are a laggard there as well, one of the only two sectors with negative earnings growth. And I understand the desire to consolidate and to make sure companies have efficiencies, but I really prefer the more secular growers at this stage of the cycle. We are not in the early part of the business cycle. We are not at the early part of the market cycle, and fundamentals really matter. I don't think staples have pricing power, and I'm more worried about their margins than I am in other sectors.
All right. Outside of the staples sector, this is a pretty big deal. I believe it's going to be the biggest deal of the year. Steve Weiss, coming over to you. Is this a bullish sign for the financials, the idea that we're going to see more capital markets activity, more deals being made, the fact that a deal of this size is coming so late in the year?
No, I think this is really a situation of a company that just didn't do well since it got spun off, and an opportunistic acquisition by Kimberly-Clark that likely would have occurred during any interest rate environment. They can take $2 billion out in synergies, so it's purely unique. Costs alone, rates alone don't drive acquisitions, particularly of this size, right? It's really an opportunity, because the cost of a bad acquisition, or an acquisition that doesn't really fit so-so, is much more destabilizing to a company and its culture, and culture is the backbone of any successful business. So you don't do that lightly. You don't do it, okay, rates are down 0.5%, 50 bips. I got to buy this company. That just doesn't happen.
I want to go to another part of our calls of the day. We have a very bullish call from Roth Capital on biotech and pharma. Carrie, I want to come over to you. You own Amgen and Novo Nordisk in your charitable trust.
Well, this has been a rough year for healthcare generally, and the biotech stocks just in the past couple of months began to really show a little life. That seems to have paused right now. Both of these stocks, Novo and Amgen, we think are attractive. Novo is down 60% from its high because they've lost a little bit of the momentum on the GLP-1 drug portfolio, but they made a big restructuring of the organization. We think that's all positive. We have new management at the company. They have an oral coming. They're trying to get more active. So we still like the stock, but yes, it's been tough with Amgen, again, a portfolio that's got a GLP-1. It has a few new cancer drugs. It's an inexpensive stock. Both of them are on as Joe knows, on a PE basis. But the market hasn't liked healthcare, and right now it's going to have to be proven.
Yeah, I'm going to ask Carrie about a particular biopharma name in a second, but look, I've been talking about the XBI. I've been building a position in the XBI over the last month. It's worked out really well. Today's the first day that it's punching back, and it doesn't feel good. So you kind of look at it, you realize that you might have to manage a risk. You don't want to have a winning position turn into a losing position. The biotech entry point for me is somewhere around 104.5. We're at 109 now. We're going to take a look at that. In the most recent rebalance, we did increase our exposure slightly to healthcare. We added some pharmaceutical names, West Pharmaceutical, not that excited about that one. Carrie, I don't know if you know Insight.
I do.
We bought Insight. It's up 5% today alone. They reported earnings on October 28th. Really strong earnings, hematology, oncology, reasonable valuation, upper teens. Yeah. $18 billion company. That one, I really like the ad.
All right, I want to get to another call. Carrie, this is one of yours. Charles Schwab, price target raised from 130 up to 139, still overweight at Morgan Stanley.
Yeah, we've been overweight this stock for a long time, and it's really finally come into its own. It sells for 14.5 times or less on next year's earnings. It's now fully integrated, the TD purchase. We see that $13 trillion in assets they have as a source of growth and enhancement over the next few years. All of the cash sorting is done. People have moved the deposits to where they want them. And we think as a broad-based institution on the financial side, we think Charles swap just offers everything that the consumers need.
Yeah, shares pulling back about 1% right now. I want to go to one more. Costco named a top pick at Oppenheimer. Joe, you own this one in the Joe T.
Survived the rebalance, barely. Costco has one more quarter to really prove itself because from the momentum score, which we're looking at 12 months in, you had some really strong appreciation from 12 months ago that's going to begin to roll off. So the stock's been under pressure. It has not been working out well. This is definitely bifurcated from what you've seen from a name like Walmart. There was a period where Walmart and Costco were both working together, no longer the case.
Yeah. Didn't Walmart just announce a partnership with OpenAI?
They sure did.
Yeah. Speaking of companies announcing those to your point, Weiss, there you go. All right. And welcome back to Halftime. Let's get to some key names reporting their earnings the next 24 hours. Might as well start with Palantir. Reports today after the close. Joe, you own this one in the Joe T ETF.
You're looking at 50% revenue, 70% adjusted EPS growth. I know everyone's going to say the valuation is an impediment, 85 times next 12 months. By the way, that's not the most expensive in the S&P 500. Albemarle and Boeing are actually more expensive than Palantir is. So I still think this is a name that we have owned since January of 2024 at $16. I've said over and over again, if I had discretion on this, I probably would have sold it 5 times over. Thankfully, it's rules-based. It stayed anchored in the position, and it is working, and I think it's going to deliver again.
Steve, we were just talking off camera, if you don't mind, about the valuation of this company. You have some questions.
I don't have any question. Phenomenal company. I mean, it's truly a market leader and becomes such an important part of our defense complex and in the commercial area as well, where they've expanded.
Commercial's huge.
So it's valuation, though, and
is 85 times that bad next 12 months?
Yes, it's pretty bad. but and I tell you, the two you cite, Albemarle and Boeing, they're in their trough earnings, so the multiple's always higher, so it's not really comparable. But look, the market's making the determination. It's not up to me. My own decision is, do I want to participate or not? And I choose not to at that valuation level. Not a commentary on the fundamentals, just about what I'm willing to pay.
And by the way, we're talking about software. This is a software company, obviously not left behind in any way, shape, or form, up over 150% year to day. I believe it was 171.
They're executing in their strategy, though. Management has done a phenomenal job. So Steve cites the commercial business. I mean, they very quickly pivoted to growing the commercial business. Now you're seeing the expansion internationally, and they're very aggressive in that regard. So this is a management team that knows how to execute, and I think that can't be dismissed or lost when you think about investing there.
No, it's absolutely true. So the question is, will it grow into a more reasonable valuation, and that's why you own it, or you believe that the growth is going to hold where it is or accelerate? Right. So
the company's quote-unquote boot camps really helping with adoption, especially in that commercial business that you were talking about. All right, next up, though, we got Uber reporting tomorrow before the bell. Weiss, you own this one.
I do, and it's going to be very interesting. I'd love to see, I've said it before, 100, instead of becoming resistance, become support. I'd feel better about it. But I don't know what I'm missing here. Obviously, it's the potential competition with robo-taxis that continues to be a hang on the stock. But I'm still there. It's not a very large position for me. But, I'm willing to see what happens in the quarter, make decision then, possibly.
So last week we had this respectful debate. I don't know why Steve is so upset about this. It made an all-time high on September 22nd at 101.99. It's 98.32 today.
It's been flat for 6 months while the market's moved higher. That's why. It's lagged the market under any measure over the last 6 months.
Last 6 months I have it 15% higher. They're going to report tomorrow night. EBITDA margins at 30%, monthly active users, double-digit growth.
I'm an owner.
I know. We're on the same page here, but I don't get the disappointment. I think you should be somewhat pleased with what they've delivered.
I'm pleased with the money I've made on it. I'm greedy, Joe. On this one, I'm greedy. I want to make more money.
We're the center of capitalism right here at the New York Stock Exchange, so it certainly makes sense. One more.
I need them to announce a deal with OpenAI.
One more. Spotify reporting tomorrow for the bell. Joe T, you on this one?
Oh, I wish here. We've talked about this one over the last 6 months, along with Netflix. I've been wrong. I've been telling the viewers Spotify is a name that I thought was going to be a pause in price that refreshes. It has not done that. It's now hugging the 200-day moving average. They really have to deliver tomorrow night, and they can't give us flat margins. That can't be the story. It can't be flat margins. The pricing and the increase in pricing needs to lift the margins. This is a seminal moment in terms of the earnings report.
Yeah, it's been a strong year, though. Shares down 1% right now, but year-to-date up more than 40%. All right, coming up. And we are back on halftime with final trades. Kate, you're up first.
Yeah, my final trades are sponsored by the letter of K, K-shaped in the consumer, K-shape in terms of the large caps versus the small caps, and K-shape in terms of the less rate sensitive versus the rate sensitive, given my view on inflation.
Mr. Steve Weiss.
Meta. Look, Meta, you have to buy this when it's down. It's almost in bear market territory. It's down almost 20% from the high. And so I think it's a buy right here.
Carrie.
S&P Global, they had a good quarter. There's more issuance. We think this is the kind of environment that they do well in.
Joe T, look at this one.
IDEX Lab, it is in the Joe T. It broke out above its 2021 high. This is pet health, doing remarkably well, double-digit revenue growth.
Yeah, remarkably well, up at just about 15% right now. Okay, that's going to do it for halftime.
All right, Brian, thanks so much. Welcome to Closing Bell. I'm Scott Wapner, live from Post 9 here at the New York Stock Exchange. This make or break hour begins with all AI all the time. It's again at the center of this market today. NASDAQ is the leader. Take a look at this scorecard. There it is. With 60 to go in regulation, Amazon, the big winner, surging after announcing OpenAI will invest $38 billion into AWS. Market likes that. Stocks up near 5%. NVIDIA having a good day as well, also among the day's top performers. It's up about 3%. How about Tesla, Micron, and Uber? They are nicely green, too. Elsewhere, the deal of the day, Kimberly-Clark buying Kenvue for $48.7 billion. Takes us to our talk of the tape. We're now in the Closing Bell Market Zone. CNBC senior markets commentator Mike Santoli here to break down these crucial moments of the trading day. Plus, Seema Modi back, counting down to Palantir's numbers, hitting just a few moments from now. Wedbush's Dan Ives is standing by right here at Post 9 to tell you what he is expecting from that report. And Mackenzie Sigalis pushing ahead to Uber results tomorrow morning. Your first take, Michael, on this market day is what? It's kind of like the same take like about AI. I mean,
it's about AI. It's a continuation of last week's tone, which was, you get a couple of the big consensus AI winners that are supporting the S&P. The rest of it's kind of ragged below the surface. Pretty hard to escape the kind of mini slow-moving growth scare that's hitting parts of this market. Restaurants have been doing nothing but going down. We know about that. So the wear and tear of soft labor market, government shutdown, we don't really know if we're getting a Fed rate hike. I don't think it's a panic. It's definitely still in the context of rotation, but another weak breath day that doesn't really seem to matter for the index trend.
Yeah. Mac, you want to tell me about Uber and the expectations there?
So, Scott, the street is bullish on Uber's Q3 print, with both Bank of America and UBS calling for a modest beat, fueled by strong rideshare demand and more users actively booking trips and placing food orders through the app. Even as DoorDash continues to take share, Uber's delivery category is expected to stay resilient. And autonomous driving, it is now central to Uber's long-term vision. Last week, Uber and NVIDIA announced plans to build 100,000 nearly driverless vehicles starting in 2027, a clear sign the company sees a future beyond human drivers. And while the AV race is heating up, UBS says the robotaxi threat remains muted for now. Plus, with rising membership in Uber One, analysts say its margins and user growth could both improve. Those shares, Scott, up nearly 60% year to date going into earnings.
All right. Speaking of earnings, thank you, Mackenzie Sigalis. We do have Seema Palantir on deck.
And the stock just hit a new all-time high ahead of the report, which is out in a couple minutes, Scott. It is now the most expensive stock in the software sector at 82 times forward sale. So the bar is really high. Wall Street is expecting a nearly 70% jump in quarterly earnings, fueled by defense spending and bigger government contracts. Key topics we'll look for clarity on from CEO Alex Karp: impact of the government shutdown, how it's addressing privacy concerns, and whether Palantir is planning to use the roughly $6 billion of cash on its balance sheet. RBC Capital thinks retail investors may start to become frustrated by the absence of some form of capital return, Scott.
All right, Seema, thank you. I said Dan Ives was here. In fact, he is. So there's a lot to live up to. The valuation's big by any metric. the analyst community is expecting a lot, whether it's at the high end of expectations or even the whisper numbers above that. So how do you assess it?
I mean, look, I just continue to view it, it's the gold standard when it comes to AI use cases. Look, from all of our work, 70 to 80% of every AI use case, Palantir is ultimately involved with. And when you put in, like, you're talking about in terms of the AI trade, pieces of the puzzle, I think this is going to be $1 trillion market cap in the next 2 to 3 years. So in terms of the actual quarter, U.S. commercial business, that continues to really be the story here, because as you start to look, this is going to be ultimately a $1-2 billion business. That's why I think valuation just over the next year, you miss what I view as really a transformational, almost historical growth.
I know, but that's a lot of hyperbole around a story that you're obviously positive on. I mean, I'm talking like, obviously the expectations are, you need to see like the growth rate.
Yep.
Like how high does the growth rate have to be relative to where the valuation is, relative to a stock that's already up 170+% year to date? Like the new orders, like what kind of growth do they need to show there? So superlatives aside, what about the stuff that matters most?
I think U.S. commercial business is really what I view as, it could be an 80, 90, ultimate 100% grower. And I think when you start just to put numbers around that, I mean, Scott, this one that was 25, 50 million that I believe now could be on a trajectory over the next 12 months to be $1 billion. So when you actually put that together, that means the valuation is one where you go from 2-3 billion of free cash flow, what could ultimately be 7-8 billion of free cash flow in the next few years. That's how you're going to justify the valuation. I think also it's what Karp talks about, not just on the government side, but on U.S. commercial.
Well, the commercial's 45% of their sales.
Yep.
At this point. Does that take the onus off of their reliance on government spending?
Yeah, I'd say 45% of revenue, 80 and 90% of the valuation. So when you think about government business, even though it's shut down, and obviously that could be a little dent, I actually think on the federal side, that's actually going to be a beat relative to all the high AI projects that we're seeing from a priority perspective. But what the street focuses on here, it's all about commercial. It's about this company essentially disrupting the whole software landscape. And that's essentially what Karp and Palantir have done.
Hey, everybody. Welcome to Blue Cloud Trading. I'm George. It's Monday, November 3rd. Markets closed. 4:46 p.m. as I'm recording this video. We saw some clips from today's halftime report and from closing bell. And we're going to cover so many stocks. It's going to blow your mind. Are you ready? Let's check out the stocks we're going to look at today. First, we're going to start off with the indices, okay, like the SPY, the Qs, the Dow, the Russell 2000, and the Euro stocks, ETFs. We'll take a look at those. But then we're going to literally run through, are you ready for this? 38, I think this is the most I've ever covered in one video, 38 stocks and ETFs that were discussed. So not all of the stocks that were talked about on the show. There was actually more than that, but we will cover all those. And I'm going to just only, we're not going to spend too much time. We don't really need to spend too much time on each one. I'm just going to give you my quick, synopsis of whether or not it makes sense to be even considering it. Mag 7 and Tesla, 3 of these stocks like Apple, Tesla, and Meta. We will also take a look at the strongest sectors. And we do have one request, EPWK, from one of our members here. So we'll take a look at that as well. Now, before we do all of that and go over those stocks, let's take a quick look at the indices here in FinViz Elite. And you can see that today, Dow was down 0.48%. You can see it dropped here, recovered a little bit, stabilized, right? Nothing major happening. The Dow today down 0.48. NASDAQ, the opposite, right? It was up 0.46%. It actually gapped up to this level, dropped, and then basically moved up slightly. So up 0.46. S&P 500 also gapped up, dropped, and then recovered a little bit, up 0.17. Not a big move there. And the Russell 2000 is down 0.32%. Okay, nothing. Again, and just to keep a quick synopsis here of the stocks that are above the 50-day moving average, it's about 61% that are below the 50-day moving average, and about almost 50 that are below the 200-day, which is interesting. So it's basically, we're right almost in the center, But today there were actually about 63% of the stocks were experiencing new lows, and 58% declining. Let's look at the heat map. So there were some winners and losers here, and you can see that Amazon and Tesla up, okay. Amazon up 4%, Tesla up 2.59%, Eli Lilly was up 3.9%, Nvidia up 2.17%. A lot of the stocks like Meta, that was down, Netflix was down, T-Mobile, AT&T, AppLovin, JP Morgan, Visa, MasterCard, they were all down. AbbVie was down, Merck. Oracle was down 1.81%. What about the sectors? How do they look? Looking here at the one-day performance, you'll see consumer cyclicals were the top, followed by technology and utilities, and then the worst performers were basic materials, industrials, and communication services. All right, now let's get into these stocks real quick. Okay, so we've got, let me go ahead and zoom in on this. Move this down a little bit. There we go. Okay, let's go with the S&P 500. So basically nothing's really happened here in this last couple of weeks, right? You can see that prices, once we broke through that 673.95 level, and that was the major thing, right? That happened here on October 24th, last week. I'm sorry, the week before, Friday the 24th. Because last week, we moved up slightly, as you can see right there, but not a whole lot, just 1% since that breakout. Prices moved up, it was up 0.19%. This is not ultra bullish, but if you look at the weekly chart, it's still looking pretty good overall. The trend is still in effect. In fact, there's going to be a tutorial on how to use this Ichimoku indicator in the last part of this video. It's about a 4 to 5 minute video. It's a pre-recorded video on basically analyzing how to use Ichimoku, this indicator that I'm using here with the Ichimoku cloud, the moving averages. So definitely check that one out. But yeah, the S&P 500 overall is still in a strong uptrend. The Qs still in a strong uptrend, up 0.48%. I want you to notice, however, that price actually is still stalling under this high. That high goes back to last week, October 29th, Wednesday. So here's Thursday, Friday, and Saturday, just moving up slowly. But these are all three of those were negative candles, which is kind of interesting. If it can break above the high of that candle, I think we'll see a continuation. So that's what we're looking for. The Dow Jones has been pulling back now since it reached the high here on Wednesday as well, October 29th. It's dropped about 1.38% or so, 1.4%. So, but finding support at the 9 period. The green line is the conversion line, or Tenkan-sen. The red line is the 26 period, the Kijun-sen, or baseline. And we're still above the cloud. So that's all bullish right there. FEZ is the Euro Stocks ETF. This one's, this one also had reached a high on Tuesday, actually, October 28th last week. And you can see here how price had dropped a little bit, but it's holding up right above that 26 period. So I think that we might see potentially a bounce here tomorrow. We'll be watching it to see what happens there. If you look at the weekly chart, we're still technically in a strong uptrend, but these last 6 weeks, really, we've been in this range here. We can see the boxes. All these candles within the box. What about Russell 2000? That one also too has been basically moving sideways here, holding up on the weekly chart. Here's the daily chart in between the two moving averages, down 0.32%, but holding up above that 244.46 level, which is a monthly level. Okay, based on that candle right there, that big candle from November 29th of 2024. So we broke above that. Okay, October 31st, Halloween, this last month, and now we're still holding up above that level. The VIX dropped a little bit, so that's a good sign. Here's a daily chart for the VIX. It reached the Tenkan-sen, or conversion line, and dropped into the cloud. That's a good sign. We want that volatility to be coming out of the market. Very important. All right, now we're going to do the following. I've basically reviewed all these 38 stocks, and I've highlighted the strongest ones with a little blue flag, and I've prioritized them up at the top here. Okay, it's these stocks that you see right here. And so I'll go in a little bit into in-depth on these, but I won't spend too much time on the rest of them, and I'll explain why. Because technically they're not very sound on one of the two time frames, either the daily chart or the weekly. All of these stocks have been reviewed on both weekly and daily time frames. Here's a weekly chart, for example, of Applied Materials, AMAT. Okay, prices above the moving averages. It's above the Ichimoku cloud. This is what you're looking for. We've got the Chiku span here, the white line still above the price 26 periods ago, or 26 weeks ago. So this is a strong uptrend for Applied Materials on the weekly chart, and here it is on the daily, also looking very bullish. Okay, up 1.98%. AVGO looks good. Even though it's pulled back down 1.92% today, it's holding up right at the Tengen-sen, so price is not broken and closed under yet. The cloud is still bullish with the Senkou span A above the Senkou span B, and the white line Chikou span, the lagging line there, which is the closing price, projected 26 periods ago. That's still above the candle 26 periods ago. So I like Broadcom. That's the daily, and there's a weekly for you. CrowdStrike on the weekly chart looks great, right? You can see here it's still moving up. Here's the daily chart. Very bullish chart for CrowdStrike as well. I like it. Up 1.64% today. INCY, Insight Corporation. This is in the biotech industry, healthcare sector. On the daily chart, you can see it was up 8.65%. Big volume today. Looking very powerful, this move. On the weekly chart, looks really good too. All right. Now, it's, in the past, we're talking about, we'd have to go back all the way back to 2017. That's a long time ago. It was at a level of 153.97. So we're seeing a recovery here in this stock on the weekly chart. And here's a monthly chart so you can get a better glimpse of what it looks like historically. Palo Alto Networks. Let's look at this one on the weekly chart. Here it is. So this one too looks good because it's, again, above the moving averages, above the cloud on the weekly and on the daily charts, holding up. Okay, but it was down 0.46% today. Palantir, also looking very strong, up 3.35%. Nice strong uptrend on the daily. There it is on the weekly chart as well. I like it. SMH, the semiconductor ETF, looks good. Okay, up 0.85% on the weekly chart there. You can see the cloud is still bullish. Everything looks good. Daily chart, same thing. TER, everything looks good here too. Up 0.72% for Teradyne. This is a stock in the semiconductor equipment and materials space. And I like this one too. There's the weekly chart for you. Very bullish. Future cloud looks good too. VRT on the weekly chart looks good. Down 0.76%. Here's the daily chart on VRT. You can see it's still above the moving averages and the cloud, but it's been dropping a little bit. XLK still looks really good too. It's just been creating a little bit of a base here. Okay, so that's the technology ETF, up 0.41%. And then, it's still, everything looks good on the daily chart and on the weekly chart as well. Now, the rest of these stocks, and that's just 10 out of 38. So that's not like a big, you can see the rest of these stocks are basically, there's something off. All right, I'm just going to go through them very quickly. We don't need to spend too much time. Now remember, if there's something technically wrong, for example, the price is under the cloud, under any of these moving averages, it's not usually a good idea to be adding a position, in my opinion, in that stock. What you want to do is buy when the stock is showing strength. And right now, a company like this is showing weakness with price under the moving averages. So I'd skip Autodesk. Amgen, here it is in the weekly chart, still under the cloud actually. Currently down 0.71%. I'd stay out of that one. You got Checkpoint Software Technologies Inc. That's down 0.56% today. Here's the weekly chart inside the cloud. I'd stay out of that one too. Costco is another one I'd stay out of. Here's the thing, right? You want to look for both time frames to give you confirmation, not just the daily, but the weekly as well. And if the long-term trend is down, okay, as you can see here, we're in a downward channel. I just don't see how the benefit in trying to jump, take a chance and getting into this, because obviously we have a lower high here than the prior one. Okay, so you can see that decline, and then it basically continued to decline even more, right? So there's an acceleration to the downside. That's not what you want to see. I also use the directional movement index here, and that helps give a little more confirmation. When you see that the negative DI, the red line, is above the green line, you want to stay out of that stock generally, okay? CRM, okay, although this one is starting to look a little more bullish, we found some support at the 200-day moving average. It's still under the cloud, so I'd skip that one. DHI, when its price is inside the cloud, you also don't want to be taking any chances there. Again, a lower high than the prior one. It doesn't look that great. KBH is KB Homes, residential construction. That one's also under the cloud. No on that one. KMB, look at this one. Here's a perfect example. You might have thought, oh, maybe I should buy this stock because we got ourselves a nice little a bullish spinning top candle. Okay. And prices dropped so much, right? It's dropped from this level of 150 all the way down to, down to 120. So you might think, oh, this is a great time to buy. We got a bullish candle here. I'm going to go ahead and add a position. Well, it just goes to show, like, no, because it dropped today 14.57%. So you can see that we started seeing even more negativity with this one when the red line crossed above the green line right there. If you go straight up, okay? And when that white line that you see there, which is the ADX9, starts to move up, that represents momentum. If you've got the red line above the green line and the white line is moving up like it is right here, that's an acceleration. That's momentum increasing, but instead of helping you, it's actually dropping further and faster, okay? It's almost like a stampede to get out. There's K-View also. Yeah, it was up 12.32%, but I wouldn't be jumping in on this. It's still under the cloud. LEN, same thing. MTUM, Momentum ETF. This one's a little different. If you look at the weekly chart, we are technically sound on this one as far as price being above the moving averages in the cloud. But if you look at the daily, okay, it's been stuck in this box and price today closed under the Tenkan-sen. I'd just wait maybe a day or two to see if it can recover. Maybe if it breaks above the highs here of this box, like the high of around 258.73 or around the 259 level, it might make more sense at that point. Here's another one, Novo Nordisk, that I'd stay out of. Look at that decline, folks. This is where the Ichimoku can really help, all right? Look at this weekly chart. It tells you so much. It tells you that, okay, there's a series of lower highs, right? Look at this. It's just stair-stepping its way down. And so to try to pick that is almost impossible. Therefore, it just makes sense to stay out of it. We don't even have a double bottom here yet. Okay, so I'd hold off on NVO for a while, actually, because it looks like it would take a lot to get up above the cloud. Probably you have to move about 45% just to break above that cloud. I know you might be missing a little bit of the move, and maybe you want to trade it just based on the daily chart, and that's up to you. But my suggestion is to look for stocks that are strong on both time frames so that you have basically synergy, right? You've got a confluence of the weekly and the daily time frame giving you, basically the same story. It's telling okay, yeah, the long-term chart looks good, and so does the daily. All right, the weekly looks good, and so does the daily. All right, let's look at Okta. I think it was Joe Terranova that said that he likes this one here. I'd stay out of this. Stay clear of Okta. It's under the cloud here. It's on. Look at that declining 200-day moving average. In fact, it's even still under that 200-day on the weekly chart. And if you look at the daily chart, same situation here, right? It's dropped from these highs back in June. If you look at the highs, it was around 127. It's already dropped 28.7% since then. QCOM is another stock that I did not flag, and the reason is because it's currently under the Tenkan-sen, the 9 period. This one looks much more bullish here in the daily chart. Let's look at the weekly chart. Weekly chart doesn't look bad at all, right? The weekly chart is starting to show some strength finally. Last week on Friday, we closed above the cloud. But that long wick also represents a lot of selling that took place throughout the week, right? If you look at a daily chart, that's all that selling that took place right there, right? It started on Tuesday, but right now I just hold off a little bit. RSP is the equal weight for the S&P 500. That's been stuck inside the box. I'd hold off on that one. SCHW, that's also under the cloud. No on that one. Okay, it's just basically consolidating in this stage. SDY on the daily chart is under the cloud and under the moving averages here, including the 200. Okay, so here's one, that super microcomputer, SMCI. We've got basically, we do have a bullish, let's look at the weekly first. Let's start off with the weekly chart. Okay, it's inside the cloud. I just skipped that altogether. Here's SPGI. This one's under the moving averages. I'd skip that one too. Spotify is under Tenkan-sen Kijun-sen, declining. You can see the decline right there. I'd hold off on that one too. Okay. Uber. All right, now this one looks good on the weekly. I do like this one on the weekly chart. You can see that these last few weeks we got above the Tenkan-sen and the Kijun-sen, the 9 period and the 26, right? And here's a daily chart. Now the problem with the daily chart still is just one little thing that needs to take place, and that is the faster moving average. The green line needs to cross above the red line. Okay, so that hasn't happened yet. The red line looks like it's probably around the same level as the cloud itself, so it's kind of hidden there. But right now, yeah, it needs to get above 96.24. This green line here. But overall, I like what I'm seeing. And just keep in mind also with Uber, you're going to run into a little bit of resistance around the 101.99 level based on this prior shooting star candle. So that is, let's see how far we are from that level. We're about 2% away. Okay, so I'd hold off just a little bit with Uber, but it's starting to show some strength. Notice how the ADX is moving up and the positive DI is above the negative DI. That's a good sign. That's what you want to see. Okay, when that white line is moving up and the green line is above the red line, that's very bullish. So we're almost there, I think. We're almost there with Uber. UPS, well, this one here has pulled back. It on the daily chart, you can see it reached that 200-day and then dropped. Let's look at this on the weekly chart because I'm guessing, it's still in a very, very, embedded. Look at Jenny, picked this one back in January. Not a good idea, Jenny. Start using technical analysis, Jenny. You'll do much better. Jenny's one of the people on the show. January 3rd, what was that? January 31st, she picked that. That would have been on this candle right here, on that big red candle. Terrible day to recommend this stock as a final trade on January 31st. Since that, let's look at the opening price there. It's dropped 31%. All right, so technicals, they're very useful just to pick, pinpoint that correct, moment to jump in, right? You should be patient because you don't want to be, and by the way, this stock since 2022, I mean, if I just measure from that point there, it's dropped 59.86%. So in a matter of 3 years, you don't want your money to be tied up in something that's declining. You want to put your money in something that's strong. It's moving up, folks. All right, let's keep going. WDAY, which is Workday Inc. On the weekly chart is under the cloud. No. Walmart moving sideways. Looks like it's ready to pop here above the 105.30 soon, but it hasn't done that yet on the weekly chart. And on the daily chart, it's inside the cloud, so I'd hold off a little bit for that one. XBI, which is Biotech ETF, that one, let's see, did it close under yet? No, let's see, 109.86 by a penny. It literally just closed up about by 1 penny when I did the analysis earlier. Let's look at the weekly chart. Okay, so on the weekly chart, it's very bullish. On the daily chart, it's only up by 1 penny. I don't know if I'd want to take a chance on that particular trade. Maybe it makes sense, folks, to wait until price gets above these highs here, and then I think Biotech will show its strength again. But right now, with this reversal candle, I'd hold off. And look at the volume also down here. See, it's more volume on Monday here than it was on Friday. And also notice how the red line is moving up. The green line is moving down. It looks like it's about to emerge. Let's wait and see what happens on that one. Give it another day or two. XLF Financials ETF is still under the cloud, so no on that one. XLI, the Industrials ETF, you get the price closing under the 9 period today, down 0.43%. But overall, it looks pretty good. Industrials looks good, and here's the weekly chart too. The weekly chart's still very bullish. Okay, so Industrials I like. XLP, on the other hand, look at this one. Consumer staples not looking particularly good. Look at the grocery stores and how they've been performing terribly. Now it looks like it's kind of stalling here at these prior lows, and maybe, just maybe, we'll see a bounce. I wouldn't take that chance though. Notice how the momentum is still declining. I'm sorry, the momentum is increasing to the downside with the ADX moving up. And look, we just went through 38 stocks in a few moments, right? Let's take a look now at Apple. Here it is, still above the moving averages. It's above these support levels of 260, for example. It's at 269.05. So Apple looks good on the weekly chart. Here it is on the daily chart. Looks good. So it gets that flag. Tesla. All right. So Tesla, let's look at the weekly chart. Tesla looks good on the weekly chart. We've got everything technically sound as far as the Ichimoku indicator is concerned. We've got a future cloud that's bullish. The 9 period is above the 26 period, all that stuff. Daily chart, it just crossed above today, so we do have everything looking aligned here as well. But I've talked about this trend line for a little while now, and I've said hey, This is the problem. As long as we are under this yellow line here, which is basically created by taking the high from that candle and from that candle and just drawing a straight line across. Notice where it stalled. Right there. Zoom in on that. Okay. Hold off on Tesla until you can get above that level, in my opinion. Maybe wait until you get above the high of 470.75. But just remember that you will run into this level, the 488.54. That's a monthly all-time high for Tesla. That's about 4% away from where we currently are. All right. See that right there? That candle? That's from 2024. So Tesla, let's put the monthly chart on here. There's a monthly. That's the high from 2024, folks, right there. Okay. It's dropped. Yeah. So I would hold off on Tesla. Here's Meta. Let's look at the weekly chart. It is under the moving averages. Tenkinson and Kijinson, so no on Tesla, even though price is above the cloud. And here's the daily for you. Not looking good, right? It's under the 200 and declining still. ADX is still moving up. The only positive, I guess, is that the volume is starting to drop a little bit. It's not increasing in volume, but this is giving us a different signal. So I'd hold off on Meta for now. Their next earnings are going to be on February 4th. Let me just check the after hours here. Post market, yeah, it hasn't really moved much. Okay. All right, and the strongest sectors for today. XLK, like I said, we already talked about that one. Looks pretty good. We talked about SMH as well. That one looks good. And XLY we didn't talk about, but it looks still pretty bullish. Prices above the moving averages in the Ichimoku cloud on the daily chart, but it keeps stalling at that 243.40 level. That goes back to this candle, okay? September 17th, 2025. Pulled back, came up, dropped, came up, created a spinning top. It's very likely that we could see it pull back again. Hold off on that one. But it's looking bullish overall. And there's the weekly chart for you. Looking pretty good, okay? Alrighty, now let's take a look at EPWK. Now, this was one of our members' requests. And I'll tell you something. Trying to analyze a 7-cent, penny stock is almost impossible, folks. There was a time when this company was at a pretty relatively high level. It was at this around $26 back in May of this year, May 30th of 2025. It went from a $26 stock down to 7 cents. I hope you didn't buy it up here, because if you did, you're down about 99.7% or so currently. Or if you're even thinking about buying this, I would advise against it, because this is a penny stock. It's not a company that I would recommend. Here's the weekly chart. You can see it's been stagnant now for multiple weeks now since June. Around the 70 cents level, right? I'm sorry, 7 cents per share level. And here's another reason. Let me just show you one other reason why you shouldn't consider EPWK. Okay, so we're back here in FinViz Elite, and I'm just gonna give you a little bit more information about this company, right? First of all, performance year to date, as you can see, down 98.24% year to date. Okay, that's not good, guys. Not good. The market cap is just $3.47 million. It's a Chinese company too. Let me just go down a little bit further. Notice that the sales, let's see, sales, it says here, year over year, 10.25%, but profit margins are negative 8.47. It shows here that, their sales are about $20 million. This is, the market cap is a 3.47 million. So it's really, really not doing so well. Look at the most recent articles here. From October 17th, down 18.4%. On October 15th, down 7.48. On October 7th of last month, it was in one day, it was down 67.16%. So that's the kind of thing that you can expect with penny stocks. What do they do? EPWK Holdings engages in providing cloud sourcing platform services. Its platform users consist of buyers who seek talent for their jobs and sellers who offer different talents and skills. The firm's buyers range from micro-sized and small businesses to medium-sized businesses from various industries. And they are headquartered in Xiamen, China. So yeah, that's doesn't even say how many employees there are here. Okay, it's blank. And so that's going to do it, folks. We actually went through all the stocks, and stay tuned for that quick tutorial. And before I go, one more thing. Let me just show you something else, folks, that I did post another members only video this weekend. There it is. It's about a 1 hour, 12-minute video where I go over my entire portfolio. I review the stocks from a top-down approach. I look at the strongest sectors, then industries, and then I pick the strongest stocks within the strongest industries. And I use Ichimoku to help me in that process. I also have a proprietary scanner that I've developed that I use to help me identify stocks. Over, basically scans over 6,000 stocks and then pops out usually on average about 5 to 10, maybe 15 stocks per day. And in order to get access to those daily, and I do share those, basically a screenshot of that scanner every day, Monday through Friday, in the posts section. So after you've joined, in order to access that video right there, you would need to click the join button right there on my channel. Let me show you. This is what will pop up. You would need to select this level, Blue Cloud. There are 3 levels. You need to select Blue Cloud Trader or Blue Cloud Legend. If you want to just get access to the exclusive member only videos, you select this one. If you want to get access to the daily trade updates that I post, okay, plus some day trading videos that I've recorded, plus the exclusive member only videos, you want to select Blue Cloud Legend. All right, that's the membership you want to select. If you want to support the channel, become a Blue Cloud supporter, and you can request a stock or ETF be analyzed on an upcoming show. And yeah, basically what you want to do is just after you've joined, there'll be a new tab. It pops up right here next to posts. This is what it will look like. Boom. It's called membership. That's where you'll find my daily posts. And if you want to check out some of my other links, and guys, help me reach 25,000. We're almost there. We're at 24,400 something subscribers currently. We're just a very short distance away from hitting a nice new milestone, 25K. That's pretty cool. Especially since this channel has only been around for 2 years. All right, so so when you click on this link here, 9 more links, right? It pops up this little thing. Scroll down and you'll find all those links here. If you like the software that I've been using, the trading software, it's called TC2000. You can get a $25 coupon for that software through here. By the way, I'll just show you what it looks like. When you click on that link, this is what pops up. You enter your email here. You can download it for Windows. You can also run this on a Mac if you have Parallels, or you can use the web-based version of this. And see, you'll receive a $25 coupon towards your TC2000 service, courtesy of Blue Cloud Trading. And it's as long as you haven't used the service in the last 12 months. So that's how you get qualified for that $25 coupon. And the same software, by the way, also has brokerage services. You click on that right there. Why trade with TC2000? Well, mainly because these folks are tied in with Interactive Brokers. And I'm sure a lot of you are familiar with that company. So all the trades are routed through IB Smart Routing. So they've partnered with them. And but what's great about it is the fact that you can actually trade right off the charts. And that's a key component, Let me see if I can find some info here. Overview. There's some info. You can see right here, stock and options charts, trading features, okay? Track your positions, okay? Pending orders and trades. This is what it looks like right there. You can practice. That's another cool thing that you can do is let's say that you're new to trading and you want to just practice without risking money. You can do that. You can create a paper trading account and do that. You can stay organized by flagging your favorites, like you've seen me flag some of my favorite stocks, or you can also keep a journal. Okay, so you can make notes and attach charts to those notes, which is kind of cool. I mean, if you're into multi-leg strategies, this is more complex too if you want it to be, right? So here's some other things that you can do. You can place multiple exit orders on positions. So like you could highlight, for example, all of your stocks if you wanted to, right click and sell everything all at once if you needed to. Let's say there's a event that you need to do that. Let's see, place limit orders on the chart. That's a really cool aspect of this. Instead of like, typing in, you can just basically find the price and trade literally right off the chart. As you see right there, you can select multiple indicators. They've got built-in option chains. You can visually see your positions. You can, if you want to add that on there, you can also take that off. Lots of indicators. Okay. And there you have it. So stay tuned now for a pre-recorded video on Ichimoku. If you look at the weekly chart for the SPY, I mean, we are obviously in a very strong uptrend here. Just really quickly, let me show you what we're looking at here. This is the Ichimoku indicator. It's a Japanese indicator that was basically incepted in the 1930s, late 1930s, folks. It was published in the late 1960s and then came here to the United States sometime in the 80s, I think, is when they started adopting it. And with software, imagine trying to plot this on a piece of paper. It's based on mathematical models, but imagine trying to do that before computers. So let me just briefly tell you what these lines mean. The green line is the midpoint of the last 9 periods. It's plotted right there. Not the closing price, but the midpoint. So think of each of these candles. It takes the highs and lows of the candle and then divides it by 2, finding the midpoint of each candle. So it's giving us an average, really. And the 9 is the green line is a 9 period. So it's looking at the last 9 periods. This one looks at the last 26 periods, the midpoint, and projects it right under the candle. Okay. The white line that you see right over here on the left, that's the closing price today. All right, so that's today's closing price projected 26 periods ago in a line form. Okay, there's different ways to plot price. So in this case, what we're looking for is for the white line to be above the candle 26 periods ago. And we're looking at a weekly chart, so that's 26 weeks ago. All right, there's the candle 26 weeks ago right there on May 2nd. And so when the white line is above it, it's bullish. If the white line is under, bearish. Here's some instances, for example, where the white line was under for an extended period of time when it probably didn't make sense to be adding positions at that time, okay, in the markets. I'm sure you guys remember 2022, right? It all started right there around 2022, and then it continued through, and then things started to emerge around mid-2023, and then the market started moving up. So what else is this indicator comprised of? It's the cloud itself, right? The Ichimoku cloud. And so that's comprised by taking the Senko span A is the upper line, and that takes the midpoint of these 2 moving averages. And what it does is it projects the midpoint 26 periods into the future. Very unique concept. And then the purple line is called the Senko span B. That takes the midpoint of the last 52 periods, these candles here. Instead of projecting it under the candle like it did in this case, it projects it 26 periods into the future. Cool, right? So we've got things that are plotting in the future. We've got things plotting in the past, all based on price. All right. And it helps to guide us, really. Think of it like that. It's a map, right? It's gonna give us some insights about what's transpiring at this particular moment on different time frames. We can look at this on a weekly chart. We can look at it on a daily chart. There's the daily chart right there. That's also bullish. What we want is price to be above the Tenkan-sen, the Kijun-sen, and the cloud. Okay. And if you're wondering what Ichimoku stands for, Ichimoku stands for at a glance. So the idea is to see quickly, visually, where are we? Okay, on this chart. Very briefly, if all these elements are in play, that we have a very strong uptrend. When things start falling apart and price gets under any of the moving averages or inside the cloud, then there's weakness, and we can identify how strong the weekend trend is. Thank you for watching. Appreciate all of you guys. Don't forget to hit the like, subscribe button, and click the join button, and maybe consider sharing this video with someone. And I'll catch you all in the next video.